Welcome back, my awesome people. Today, I am honored to have back on the Another Jacob Rant channel is Adam Patti, the CEO of Vistashares. Now, if you haven't seen our last interview, it was dynamic. We went dive into AI. We've been diving into the two main staple ETFs that they had at that time. But now on the second interview, they have more ETFs. AI is exploding, as you can see. And of course, we would love to talk about Warren Buffett's retirement because there's a lot of strategy in that as well. Adam, thank you for coming back on the channel. We always love to see you back here. How is everything going?
Oh, well, man, thank you for having me. It's great to be on the show, and things going great. We're really fortunate. The company's been growing really fast. We just blew through 400 million total assets as a company, which
Nice.
is still small in the scheme of things, but 6 months in, it's really fast growth. So it's great. It's great to get the word out.
It is an exciting time of year right now. We have crypto booming. We have the tech sector booming. Pretty much the stock market as a whole, the S&P is booming. So as others have said, it might be the golden age of investment, but we'll have to see about that. So for those that did not see our first interview, let's get right into it, Adam. Can you tell us more about yourself, Visa Shares, what you do, the core mission, the history, all that background stuff?
Yeah, sure. So I've been in the ETF market since 2001. I started my first ETF company in 2006. It was a company called Index IQ. We specialize in liquid alternatives. We created something called hedge fund replication. We were to replicate hedge fund strategies, embed them in ETF structure. Ended up building that up, selling it to New York Life in 2015. I was at New York Life Investments for 3 years, building out their global ETF platform. Left there in 2018, was locked out of the industry that I love on a non-compete for a few years, and was fortunate enough to get back in and to co-found Vistashares. So what Vistashares does is we create different products for different market cycles. We are not going to be a company that has 150 ETFs out there. We try to bring out really high quality products that have very distinct use cases, that are well tested, that are institutional quality, and that we have three different families, and that's by design because the different families work well in different market environments. If you're in a volatile market, we've got products that are more stable core products. We've got more growth equity products. We've got tactical trading products. So, that's what we're trying to do. So Vistashares, my partner in this is a guy named John McNeil. John was the former president of Tesla, COO of Lyft. He's on the board of General Motors. He's the vice chairman of GM's autonomous vehicle division. Brilliant guy. Has started, 6 or 8 different companies in his time. And he's great partner. So we're building a company that hopefully is a little bit different than the other ETF issuers out there. We're taking a lot of time with the types of products we bring to market, and we'll see how it works long term. But so far so good, and we're really excited.
I love to hear that because having a backbone, having a strong management team, consultants, experts behind you is always going to be key, especially in this new world of AI, this new world of technology that we're entering. So having, someone who's working with GM, who knows, maybe Visa Shares might pull out some EV ETFs down the line. But now looking at the ETFs that you actually do have. So in the last interview, we talked mostly about AIS and OMAH. AIS is the artificial intelligence supercycle, and the OMAH is the Berkshire, which pretty much follows the Berkshire index that Warren Buffett created. But you did create a new ETF since our last interview, WILD, which is the Visa Shares Animal Spirits 2X daily strategy. Before we talk about the previous ETFs, can you tell us more about Wild?
Wild is a great product. So this is exactly the type of thing we try to do. So your listeners, your viewers know many of them are probably big users of those single stock levered ETFs. So if you really like Tesla, you really like Nvidia, you buy one of the ETFs that gives you 2x exposure to them, and you hope for the best, right? You hope you got the trade right and then it's on the right day. Otherwise, you can get your face ripped off if you have the wrong day or the wrong trade. But they have solid use cases, right? I mean, they're built for traders who have strong views on individual stocks. So I was intrigued by that. And so, how do we do that? But how do we do that more with a more institutional bent? So I went out and I talked to a lot of institutional trading desks, institutional investors. How do you get this quote, this high beta exposure? They don't necessarily want to take a bet on a single stock. What they do is they look for a basket of stocks that they have high conviction around. So that's what Wild is. So Wild is it's 5 stocks. We rotate them monthly. We leverage them up 2x, and we reset the leverage daily. So it's really similar to the single stock ETFs that are out there, except that it's 5 stocks. So then the question is, all right, well, how do you come up with 5 stocks? You just pull them out of the air? No. What we do is we actually look at all the single stock levered ETFs in the market every day, every month. We're looking at these, and we're looking at where the asset flows are going. So we're looking at those single stock levered ETFs that have attracted the most assets and the ones that are growing the fastest. And then what we do is we have a systematic process to score them, score the names that are underneath each one of those ETFs. Excuse me. So we don't buy single stock levered ETFs. We're looking at those products as data points to try to determine where investors are putting their money. We're trying to gauge investor sentiment. And we pick the 5, quote, hottest stocks that are growing the fastest and have the most assets already put against them. So, and that changes every month. So basically and that's why we called it the animal spirits. It's, trying to harness the wisdom of the crowds, the animal spirits of the marketplace. Because as we know, the market now is very narrative driven. It's been so for many, forever really, but even more so now with all the information that's coming around. So narratives around stocks drive stock prices in many cases. And, what is the underpins that is where investors are putting their money. So, we're looking for where they're putting their money and we're capturing those in a portfolio. So right now, our 5 stocks are Meta, Google, AMD, I'm just reading it off my screen to make sure I don't get it wrong, Apple, and Tempest AI. And that'll switch every month. I mean, some of them might be the same, but some of them might go away, depending, again, where investors are putting their money, because that shows momentum. And so it's a very different type of product. It's built for traders, but it's built for traders that don't want to get their face ripped off by choosing one stock that's wrong. We've got 5. And you're probably going to be right about a few of them. And performance has been spectacular. So it's been a great product. Really, yesterday it was up 4.6%. I mean, the product's been performing really well. Now, of course, it can go down that amount as well. When we launched it, the day we launched it in June was the day that Tesla got killed. I don't remember what happened. Something with Trump and Elon.
Something in the White House, yeah.
Yeah, they were fighting, and then Tesla got killed. So yeah, we launched on that day. So I think we were down 6% that day. So it can happen, but at least you have a portfolio approach to getting high beta exposure, and it's built on the wisdom of the markets.
And you know what? That is a very, very smart ETF, as I would say, because some people might invest only in Meta. And if Meta has a bad day, then they have a bad day, because sometimes Meta might have a bad day, but Apple might have the most amazing day. So I think by having a very, very small holdings, 5 single stocks that pretty much are performing the best these days, because we know the tech sector has been booming for the past, I would say 3-4 months, based off of, NVIDIA's last conference, the way AI is going, especially with autonomous and humanoids and so on. So, and Meta, I mean, I'm sure you've seen recently, they're spending hundreds of millions of dollars, recruiting all these amazing engineers and coders from other like OpenAI. So there is a big shift happening. And I think you guys are very highly positioned to take advantage of those gains. So, I think it's an amazing ETF, because when you're thinking of wild, you're like instincts, animal instincts. It's okay. It's like common sense, right? What is going to perform well right now? And you have captured those that are performing well. And also another ETF that has been performing very well is AIS. Can you tell us more about that?
Yeah, AIS is, look, AI is just the place to be. Whether you like AIS as an investment or not, I'd encourage everyone to take a look at AI as a sector, because look, there's just hundreds and hundreds of billions of dollars being deployed into artificial intelligence. It's the new arms race. All of these hyperscalers out there, the Metas, the Amazons, the Apples, the Microsofts, they need to win. So they're putting the money out there to create more compute to enable them to create better applications down the road that actually add value for consumers. So what AIS does, which is very different than any other product in the marketplace, we are the AI infrastructure ETF. That is what we are focused on. So while everybody else, when you buy an AI ETF, you look under the hood, you notice, wow, I've got the Mag 7 for 30% of my exposure. Okay, I mean, sounds great, but you also have the Mag 7 and your S&P 500 in Qs. You've got probably own those stocks individually as well. So it's where the money is going. Again, it's all about following the money with investing, right? So whether it's Wild following the money there or here following the investment dollars. So where is Meta, where is Amazon putting their money into? They're building data centers, they're building semiconductors, they're buying semiconductors, right? So what AIS does is we have what's called a bill of materials process. We actually analyze the supply chain for the data center business and the semiconductor business to determine what are the companies that create the components that go into building a data center, for instance, or a semiconductor. And those are the companies we're buying because those are the companies that are collecting all these hundreds of billions of dollars in investing. It's a very different approach. We think it's an intelligent approach because that's where the profits are. Meta is not an AI company. They will one day become a predominantly AI-driven company, but they are not today. They're not getting any real revenue or profits from AI. The revenue and profits in AI are in the supply chain. So for instance, I'll just give you an example. Most people probably wouldn't know that 30% of the cost approximately for an AI data center is in cooling systems. Boring cooling systems, right? You got to keep the chips cool. You got to keep the facility cool. You keep all the equipment cool, right? So 30% of your cost. So these hundreds of billions of dollars are going into building data centers. Approximately 30% of that is going into cooling systems. Who's the leader in cooling systems? It's a company called Vertiv. So, it's one of our top holdings in AIS. So most investors don't have exposure to these companies. They have exposure to the Mag 7. So when in investing, you want to be diversified and you want to have exposure to the companies you don't have exposure to. And preferably you want companies that are collecting the profits and making the margins. So for the next 3 to 5 years, the profits in AI are in the infrastructure business. That's just a fact. And AIS is the only way to play that really in the marketplace.
I think that is the most intelligent statement and point when it comes to AI because I think we made this point in the last interview where instead of trying to hunt for the gold, why not be the one selling the shovels, the pipelines, doing everything around the infrastructure. Instead of being the one to actually apply AI, why not build infrastructure around it? So, I mean, AIS is definitely positioned to be taking over a lot of other industries because the data centers, the cooling centers, they will work for AI, but then once healthcare gets into AI, once industrials get into AI, those companies now have to go to those sectors and help them conduct their AI business. And which is a very good point because I think it was last year, I believe Microsoft or Google, they said they had to put their data centers under the ocean to keep it cool because there was nothing colder than the ocean. And I think cooling and data centers are definitely, because especially with energy as well, I think the energy sector will definitely feed off of this. And now let's talk about OMAH, the other ETF, which follows pretty much Berkshire Hathaway, Warren Buffett strategy. You have the Coca-Colas, you have the Apples. But now that Warren Buffett has retired, what do you think about his investing principles? Do you think they will still influence not just Berkshire, but maybe new up and coming investors? Or do you think maybe the Warren Buffett era has kind of faded away?
I mean, Warren Buffett is the most successful investor in the history of the world. Greg Abel, who's the CEO now, has been there for what I think 20 or 25 years, learning under Warren Buffett. In fact, it's been it's pretty well understood that Greg Abel has been running the business for several years at this point already. We don't anticipate, and I don't think there's anyone in the market that anticipates any type of wholesale change in investment strategy. It is a time-proven investment strategy of being patient, looking for value opportunities, and keeping a lot of cash on hand to scoop things up when the market presents them. So we don't anticipate a lot of changes. Obviously, Greg Abel is a new CEO, so he's going to want to put his stamp on the company? I hope so. Maybe he'll get more into technology. Maybe he'll get into some of these more these sectors that Warren Buffett wouldn't invest in because he just didn't understand.
Like
And he would say,
cryptocurrency. I know Buffett was so anti-crypto.
yeah, and I don't know that they're going to go that far off, but maybe there's more technology related companies they get into that Greg understands better than Warren did. And Warren said, I won't invest in anything I don't understand. So, what OMAH is, it's a very simple product, and it's designed, to give you the similar exposure to Berkshire Hathaway itself. The equity portfolio is made up of Berkshire Hathaway B, and the top 20 publicly traded holdings of Berkshire Hathaway. So it's Apple, it's Bank of America, it's VeriSign, it's MasterCard, it's Visa, it's Amazon, it's Apple. Did I say Apple? So it's the same portfolio. The difference being Berkshire Hathaway doesn't pay a dividend. We use an option strategy to target 15% annual income, and we pay that monthly. Our target per month is 1.25%. And we've been doing it since March, and we've hit that 125 nicely every single month, and that's the goal. We have target 15 in the name. We better hit it, or that might be an issue, right? So yeah, so it's invest like Buffett, but with 15% income opportunity.
And
It's
yeah,
very simple.
and so just to go to the strategy that you use for your ETFs, the option strategy that you use, can you talk more about that? And also, I know OMAH also has kind of like a younger sibling,
Yes.
QUSA, I believe.
Yes. So we think providing the 15% income is a very sound strategy for investors in any market environment, but particularly now. Yes, the market is at all-time highs. Yes, it's booming, but you know what? It comes down to, and it's been extremely volatile. Whenever the administration comes out and says, "Oh, I'm going to fire Powell," I'm not going to fire Powell. The volatility is pretty high. So you want to have core holdings that are stable and just generating that 15% income with a very high quality core set of holdings. We think is important. The market has also been in a momentum driven market for many years, so we believe we're now going into more of a value and quality tilted market, and that just happens in cycles. So Berkshire Hathaway is known for their value orientation, so that's OMAH. So QUSA is a quality tilt. And what that means is what a tilt or a factor tilt, and that's a fancy way of saying we use financial metrics to identify certain attributes of companies. So if you're looking for what they call quality companies, what you're looking for are companies that are highly profitable, they have low debt, and they have stable earnings growth over time. Very simple. So what we do there is we take the Russell 1000, we score all the companies in the Russell 1000 based on high profitability, low debt, stable earnings growth, and we pick the top ones and we put them in the portfolio. It's a very standard way of kind of creating a quality portfolio. So in this portfolio, we have 27 equities, and it has the same exact target 15 strategy as OMAH. So it's 15% annual target, paid monthly, 1.25%. And that product came out in May. It's paid out twice. It's paying out again, I believe, on the 28th of this month, at the end of the month. So yeah, it's a similar strategy, a different portfolio of equities.
And that's what we love on this channel. We love, the dividends, the fixed incomes, the option strategies, because, the average person like myself, if you showed me an option screen, I would not know where to start. So having firms like yourself and experts like yourself to do the technical stuff for us, while we still get a 15% return, APY, then you know what? I think that's the best. So, do you think that, so now that we're talking about traditional investing, where it's very safe, less risk, high profitability, strong companies, what do you think about the other side with this new landscape of investing where, you know, I believe at 18, most people can open up an account and just start playing around with the market. What do you think about the shift in the more riskier landscape that we're in?
Well, it's an interesting dynamic. So yes, the market is more accessible to anybody right now, which is good, unless you get yourself in trouble, obviously. But what I've noticed, and look, we are building our business. We have a sales force. We sell into family offices and RIAs and all those and advisors. But if you go look at on X and you follow me on X or something, you'll see the groundswell of support we've gotten from the retail community. And frankly, we're trying to serve the retail community primarily as a primary a group. And the reason for that is it looks to me that the overall investor base in the retail community has gotten a lot smarter than what I was when I was younger, right? So these are, 25-year-olds, 30-year-olds, 35-year-olds, or some of them are 22 and 21 years old. And they all have seemingly the same goal of kind of dripping into investments, building up a dividend base, building up an income base, so that when they're 40 years old, they have a certain amount of capital that's coming in every single month or every single week, where they can retire early. And it's really brilliant, because when I was 25 years old, all I wanted to do was the hot stock. That's gonna double or triple, and of course, it always would never double or triple. It would go to zero, and I'd lose my money, or lose a lot of it. So I think it seems like younger investors are just much smarter now. So even in volatile markets, in kind of riskier markets or markets where they're going straight up, yes, some are using those single stock levered ETFs to generate alpha, but the majority of them seem to be trying to build sound diversified portfolios using income strategies. And it's really incredible. And that's where we're getting most of our clients from.
And I know Vistashares also has fixed income equities. Can you tell us more about those?
We don't have fixed income.
Oh, sorry,
We
not
don't.
fixed income. Providing some type of income through your option strategy.
Oh, I'm
So yeah.
Yeah, my apology. I misunderstood. Yeah, so we use covered call strategy. So both on OMAH and QUSA, we're using a traditional covered call strategy. We sell calls on out of the money calls on all the underlying, so it's a fully covered portfolio. But the difference here is that some of the covered call strategies out there, they're trying to get as much income as possible every month. They're trying to max it out as much as possible. We're not maxing anything out. We want to hit 1.25% per month. That is it. Not a penny more, not a penny less. So when we set our calls, we're looking to scrape that 125. Once we scrape that 125, we'll reset into a new option. But we're not going to be holding on to things, trying to generate that last penny, because that's when things get risky. So we're a little boring. We're just, again, that 125. And if for some reason we make more than the 125, we're taking the remainder, we're not paying it out, we're putting it back into the NAV. In fact, we also take the dividends generated from the underlying securities in the portfolio and put that back into the NAV. So we're not using that as part of our 15% per year. So
I
it's a
like
little
that
bit,
because
yeah.
a lot of companies they would, just pay everything out without putting it in the NAV, even though a lot of companies do need to put it in the NAV because, their stock might have had a bad hit for a month straight. So even though they're paying out the dividend, their NAV might be depreciating a little bit, but it's so refreshing to hear companies putting it right back into the NAV to keep that share price going higher while still paying out the dividend. Yeah.
Yeah. So our primary goal is to generate the 15%, but our secondary goal is capital appreciation. So we think it's important. We don't want to see that NAV erosion. And look, you can't control performance, right? I mean, the quality tilt, it will be in favor, it'll be out of favor, and momentum will be in favor, out of favor. And you can't help that, right? So, but over time, we believe these portfolios will appreciate. Now, to be clear, any option strategy that has an option strategy, on layered on top will never perform as well as a straight equity portfolio. So if you take our Omaha OMAH portfolio of 21 securities with the covered call and without, we should underperform the one without the covered calls, because there's no free lunch, right? You're generating the income, it's coming from somewhere. So typically you can expect 75-ish% of the upside and call it 85% of the downside in a covered call strategy versus the identical equity portfolio without the covered calls, if that makes sense. I
It
want to make that.
does. And I think like personally, a lot of my viewers, and even myself, we love our covered call option strategies. We love our ETFs that definitely pay out. And I think it's just a little sacrifice that you have to make for for a good way to mitigate the risk. One, you're getting an income every month or every week, compared to, going for the underlying equity, and it might have a rough 6 months, it might have a rough 8 months, and you're not making really anything from it, just kind of waiting and waiting and waiting. So let's take a small little pivot to the AI world. So obviously, right now we have so much going on with AI, with video AI, pictures AI, ChatGPT, OpenAI. They're doing some crazy, crazy work. But there's also other issues such as the deep fakes, the propaganda, what is real, what is not real. Because, sometimes you're scrolling on social media, you're watching a wonderful video, and then you read the comments and everyone's saying it's AI. And then you look closer and you're like, wow, it really fooled me. So what do you think about the future of information, misinformation? How are we able to differentiate what's real, what's not real? What are your thoughts on that?
Oh God. I mean, that is a big question, man. That is, yeah, I think, look, I think we're headed into a very exciting time, but a very scary time. I mean, to be honest with you, right? I mean,
Definitely.
I'm focused, of course, on creating a portfolio to generate returns for my investors. So I have a little bit of tunnel vision there, but from a macro perspective, gosh, there's got to be some controls. There's got to be some guardrails put on this thing, right? There's got to be some type of filters that can determine if a video is real or not. It's scary and it can cause big problems, right? I mean, not just reputational problems or issues among society, fighting among each other, but it could be a lot of danger involved too, right? I mean, you know,
And whose responsibility do you think that is? Do you think it's the creator of that specific AI that needs to maybe put a little mark of some sort or like a watermark? Or do you think it's the responsibility of the platform? So if it's on Instagram, Instagram has to put something out saying this is AI or
I
uh
think it's both. I think it's both. I mean, I think there's got to be a multi-layered protection scheme going on at this point because you can't wait for the government to regulate things and they just mess things up anyway. So I think the companies they have to be good stewards for the consumers. And so if you're creating it, there should be a watermark on it, right? To your point, the platform should have the protective filters on within the platform to determine what's real, what's not, because otherwise it's going to get out of control. And the thing is, it's going to get out of control very fast. I mean, you see
very
already
fast? Yeah.
mentioned. I mean, I was on X today watching some stuff and watching some entertaining videos that were obviously not real, but they were so real that if people didn't say, "Oh, look at this fake video," I would have thought it's real. I mean,
Oh, 100%. I
I
think
mean,
we've
look.
all been fooled a few times in the past, maybe month, with the expansion of how good AI is.
Oh, I mean, I was one of my colleagues over at DVX Ventures is my partner. It's John McNeil's company. One of their head of strategy is a brilliant guy, and he's been playing with a lot of AI tools. And we were trying to come up with like videos that we can use within Vistashares to communicate our products and stuff like that. He took an article of me from like 2015, and I'm standing like near the beach with a suit on, and he all of a sudden it became real, and I'm walking down the boardwalk and he was pretending to promote like Wild, and he had a bunch of lions come around me, and it looked real. It was crazy, and I'm like, this is nuts, man.
You should have
This
called yourself the Lion King at that point.
Oh yeah, God, it was crazy. So yeah, it's there's got to be some guardrails. So it's I think the world is going to change in ways we can't even imagine over the next, forget even 10 years, 3 to 5 years.
Oh yeah, it's gonna be a whole different world. And so what do you think is the most overhyped aspect of AI? I know we're doing so much, but what is the most overhyped thing? Because there's a lot. Everybody's saying they can claim to do this and do that, but what are your thoughts on that?
I think the large language models, and this goes against a little bit what I was just saying about how crazy some of the stuff is that we're seeing, but I think the large language models still have a ways to go, right? And at least in terms of business cases to generate revenue from them. So when people are, again, when they're looking to get AI exposure in their portfolio, we're years away, I think, from revenue models. Maybe the technology is there to create some wacky stuff. But the revenue models around it, I think, are going to take quite a bit longer. So the Microsofts and the Metas and those it's really more about creating the power, the ability to create the applications, but the revenue models are way down the road, I think. So again, that's why we think the infrastructure is where you want to play. But
So they just got to figure out how to make money off of it. So they might have the product, they might have everything going, but now it's okay, how do we serve it to the consumer where something is actually coming in? Okay, that's so the science is done. It's just now the business aspect that they got to figure out.
I think so. I think the business models are still way off.
And so, what do you think about, for example, right now with US and China tensions and tariffs and all of that that's going on? Of course, coming out from the East, China, Taiwan, they're coming up with the most incredible technology, chips, and so on. Microsoft and Google are just coming out recently with their quantum chips. What do you think this US and China tension is going to do? Do you think it is wise to invest in Chinese companies at this moment, or it's a good decision? For example, does AIS have a lot of maybe foreign country technology companies, or what do you think?
Yeah, I mean, look, China has great technology. I'm just pulling up our country breakdown now. Yeah, we have about 9% allocation to China within AIS, but um, yeah, I mean, look, the technology coming out of China is, it's A plus, right? And they're not far behind us. And this actually goes to a conversation. We had an investment committee meeting yesterday for AIS. So on my investment committee is two AI experts. It's John McNeil, and then we have this guy, Sunny Madra. Sunny is the president of a company called Grok, GROQ. They're one of the larger players in the inference portion of the development cycle. And they're part of, I don't know if heard about that whole thing in Saudi Arabia called Humane. They're creating the biggest inference campus in the world. And so
No, I
Grok,
actually haven't heard of it.
yeah, it's huge. So Grok is the centerpiece of that. They got $1.5 billion investment to build out part of that in Saudi Arabia. So Sunny is one of the premier experts in the world, as is John. And we had this exact same conversation, which was interesting. So what we were talking about was that, see, China is taking a very different approach to the United States. They're taking an open source approach. So their technology is not necessarily as good as ours, but it's very close. So what Sunny and we were talking about was, the US companies are putting hundreds of billions of dollars of capex into all this infrastructure, which they have to at this point. But it's only giving them around 30 to 60 days advantage on their technology versus the open source models. So that is an interesting thing. So China's taking a very different approach, and because of the open source nature of their app of their technology, people are adopting it and they're building upon it. And it's going to be interesting to see which models actually win long term. The heavy capex spending, or the open source, the open
So
source
you can
model.
be an average person in China, but you're just, brilliant in coding or creating programs. And because it is an open source, you can pretty much do it yourself. And I guess that's what China's trying to do. Just have as many people attempt, and then create and I guess pick the best out of the best. Whereas in the United States, we have kind of like a closed circuit, right? Like companies don't want to give up their blueprint or their secrets
Yep.
of how they did it. And do you think this is going to hurt the United States in the long run, or do you think China's model is just not only giving China the advantage, but pretty much anybody in the globe to, hey, here's the blueprint, go try it out.
Yeah, it's gonna be interesting to see. I mean, look at Apple. They took the closed approach. They've done very well. So I mean, there's benchmarks in both models, but it'll be interesting to see. But it's a very different philosophy at this point. So ours is much more capital intensive than theirs. They're spending a lot less money for good technology. We're spending a ton of money for amazing technology, but with a very short lead time before the good technology becomes amazing, right? So it's not a big leap there. So it'll be interesting. So we didn't have an answer on our investment committee. We just thought this was interesting. It's something to look out for, and are there companies more specialized in the open source area that we should be looking at for our portfolio and things like that, which, we couldn't identify yesterday. But yeah, it's interesting. But the other thing you mentioned earlier was the energy component, right? So that's another big bottleneck for the development of AI. And Sunny had a very interesting comment. In 2005, there was a total of 2 gigawatts of data center power in the United States. Okay. Now, fast forward, and you saw Meta, their announcement a couple of days ago, 20,
Yeah.
and they're going to be creating multiple 1 gigawatt data centers, just them, just in that investment. So the average large scale data center right now is 1 gigawatt going to 2 gigawatts. In 2005, we had a total of two. So right now, there's a big problem. The power grid simply can't handle it. So to your point, right, put them underwater. There was a crazy article in CNBC talking about putting data centers on the moon. This was yesterday,
Oh,
literally
wow.
yesterday, an article. Yeah. Um, just trying to figure out how to get that kind of the cooling, right? They're
Imagine a
building.
technical issue happens, you have to fly to the moon to fix it.
Yeah, kind of difficult, I guess. But they're recommissioning nuclear power plants, right? They're using hydropower. Another thing they're doing, all these big data center campuses are putting power generation right on the campus, and which is interesting because a lot of them are natural gas fired plants, which is great because we've got plenty of natural gas in the United States. But guess what? We don't have. We don't have the turbines you needed for the generation facilities for the natural gas. So a company like GE Vernova is the leader in turbines. We recently just put that in our portfolio about 2 months ago
Nice.
because of that problem. So, there's a lot of problems on the energy side, and micronuclear. There's all types of things that are going to be happening again as the infrastructure is built out. The electrical power generation infrastructure is going to need to be built out as well. So that's another very big opportunity.
That is definitely a big issue. Up here, especially in Canada, we barely even have enough chargers for EV cars. So imagine, us having, whether it's a gigafactory, whether it's expanding the electric grid or having a miniature nuclear kind of compartmentalized energy source that are posted in wherever it's needed. And so with all these commotions in AI, I know it's a big thing, pretty much mostly in the Western society, I would say. I haven't really heard much from India or even Africa and so on. But with all this energy and all this money that we're expending to AI, do you think that we might get into a recession with our overspending? A lot of people are saying that there's a recession coming up in 2025. Personally, I think it might happen in 26. We just are just printing money. We're not really consolidating the money. What are your thoughts about a recession, whether it's a tech recession, because right now we're flying, we could drop. What are your thoughts on that?
Oh gosh, I mean, it's anyone who just claims they can pinpoint it. I don't really listen to it because there's so many variables, right? I mean, look, I think the biggest risk to the markets now or the economy are the global macro risk, the geopolitical risks, right? Of a war, the Ukraine war with Russia spiraling out of control, something in the Middle East spiraling out of control. I think that something like that would be the most likely trigger to a recession. In terms of the money supply, I mean, yeah, I mean, we're still overspending. We got to cut costs. I mean, Trump keeps talking about bringing down the interest rates to save $1 trillion on interest payments, but something's got to give on the spending in the United States because it's just we're just spending way too much on a lot of wasteful projects. So that's going to have to be right sized for sure. Whether that's the trigger to a recession, I'm not so sure. I think it's really more geopolitical driven. That would be my best guess.
Yeah, there's so much going on. It could be any of those factors. It could be our own debt bubbles. It could be geopolitical. It could be another assassination attempt that just brings the markets down. So
Yep.
it's been kind of like a soap opera the past 6 months to a year. Okay, so I know I asked you this in our last interview. We did talk a little bit about crypto, and you said Vistashares may not enter the ETF space when it comes to crypto. Have your thoughts changed since then? What are your thoughts on that?
Anything's possible. I'll leave it there.
I like
Uh,
that. I like that because right now, crypto is going up a lot. A lot of institutions are jumping in. So I just wanted to know if your opinion changed since the last time.
Yeah, I mean, the difference for us is that anything we do is going to be something that has never been done before. It's got to have a very strong use case for portfolio construction, and it's got to be battle tested in terms of our methodologies. So, that all takes time. The battle testing, the stress testing to make sure what we're doing is sound. It's certainly something we're looking at.
And I'm sure shareholders really appreciate that because a lot of CEOs sometimes they take a massive risk, doesn't play out. Shareholders are upset.
Yeah.
CEO the C-suite team gets into hot water. But I like the way
Yeah.
that Vistashares make sure that the shareholder is looked over first. Okay, so Adam, before we end off this interview, is there any advice, any type of mentorship opinions that you may have for maybe a new investor, but also maybe someone that wants to specifically get into, building portfolios, maybe get into AI? Is there any type of advice that you may want to put out there for them?
Yeah, I mean, my advice is always the same. It's very boring. It's have a plan, create a very well diversified portfolio, made up of all the different asset classes. You can look up, write in a book on, a book or online what kind of, how to create a portfolio. And once you create that core portfolio, you could carve off a piece of your, of your cash to, express your views and some of the sexier things out there. But for any investor, especially those that are just getting into it, create a nice diversified portfolio. Stick to your plan. Don't get spooked. Don't sell out when everyone's selling. Keep investing over time, and you do very well. Just have patience.
Thank you for that advice because that is the exact advice that I used when I first started investing. My first three stocks were Coca-Cola, Iron Mountain, and AT&T.
Yeah.
Strong, solid companies. But then COVID hit and everything just kind of reset. But so audience members, remember, please do your own due diligence. If you're just starting out, boring is the way to start. I know some people like the flashy, 7 p.m. they buy a stock, 9 a.m. they sold it. I know that's kind of nice and exciting. But if you're looking for a long-term path, a long-term play, please start with the boring. Adam, thank you for being here with me today. I know it's the second time you're on the channel. I'm looking forward to many, many more because every time I see you, there's always something cool and interesting that you have. Is there any last mentions or anything that's coming up that you want to put out there to my audience?
No, I just thank you to you and your audience, because honestly, our success to date is because of you and your audience, and people like you have been kind to me and let me get on to give our spiel and talk about our products. So I'm very fortunate about that. We've had some really good success so far. Please give me a follow on X, Adam Patti, or take a look at our website, vistashares.com. We've got a lot of good materials, I think, that aren't salesy. We try to create actual educational materials that educate rather than sell. So I'd love, take a look at it, and obviously always hit me up if you have any questions.
Definitely. And thank you so much, Adam. And my audience, I've checked out the website many times. There's so many resources that you can use, even as a beginner or even as a professional investor. Please check out Vistashares. I will have all their details and information in the description box below. So make sure you like and you subscribe. Adam, until the next time. And my friends, until the next time, stay ranting.
All right.